Earning an additional income source that earns you 1 to 2% a month of the capital invested is possible through selling options. I know there's a lot of preconceived ideas about options being incredibly risky, but I want to teach you how to statistically over time become the casino and not the gambler at the casino. See, there's a critical difference between buying and selling options when it comes to odds. And hint, options favor the seller when it comes to the percent of winning trades. My name is Dustin and welcome to my YouTube channel where I educate you on investing ideas that focus on cash flow to either reinvest for more cash flow or to pay for your everyday expenses. I'm going to be teaching you the key principles when it comes to selling options, including the most important fundamentals such as what an option is, and we'll be going through important scenarios when selling an option. We'll cover more advanced concepts such as the Greeks and applied volatility in another video. Shout out to AD Investing, Money Games, and Galen Mass Investing for the oh so kind comments on my first video. And to all my new subscribers, your comments, likes, and subscriptions mean more to me than dividends and options premium themselves. So smash that like button and subscribe, and hit the bell to get notifications for more videos just like this. Unlike most people who trade options, I focus on blending options with a strategy that focuses on fundamental analysis, which I've discussed in my first video on what makes a solid ass company to invest in which you can find the link to in the description below. This strategy of selling options on companies we want to own makes sense in that we combine fundamental analysis while leveraging the sell of options to make potential income. Imagine getting paid to want to own a stock. That's what we'll be covering. Now, options is not rocket science. I'll simplify everything for you so that you have an actionable game plan to start selling options to make cash flow. Now, let's go through how much I make through selling options. Let's go through an example of when I started implementing my strategy of selling options from last October 2019 to January 2020, this year before the Rona started to really hit the markets. Here's how much I made from selling options. In October, I totaled $1,224. In November, I totaled $859. In December, I totaled $129. And in January, I totaled $872. I used a principal amount of around $28,000 and went for more aggressive option selling strategies to generate around 3% a month in the several months. As you can see, income from selling options is not necessarily stable as say something like dividend investing, but the returns can be substantially much more in that you can have cash flow that exceeds most dividend paying companies. From February to May of this year, I decided to ease off from selling options to focus on buying undervalued dividend stocks since the market was on a wild downswing of 35% drop overall. Since selling options is a longer term strategy than say day trading, I still profited a significant amount in May 2020 at $1,246 from selling options, and I reinvested those profits into dividend paying stocks, to which you guessed it, to increase my stable cash flow. Now, what is an option? Let's discuss what options are. We have two types of options, calls and puts. When you buy or sell a call or put, you have to do it on an underlying, which is a company's stock you're performing an option event on. With calls, you want the underlying or stock price of a company to go up. Buying calls is bullish. With puts, you want the underlying or stock price of the company to go down. Buying puts is bearish. Now, an easy way to remember the direction of what you want for calls and puts would be the phone analogy. We want to pick up a call and put down the phone. Simple, right? An option is simply a contract to give you the right to buy 100 shares at a certain strike price of your choosing. Now, let's simplify options with this relatable example. Pizza. Options are like pizza coupons analogy. Remember those pizza coupons that used to clip out? I still do. Those coupons give you the right to buy pizza at a discounted price, but you're not obligated to buy pizza at a discounted price. The pizza chain that provided those coupons, however, are obligated to sell you the pizza at a discounted price to you, the consumer, if you decide to use that coupon. Those coupons have an expiration date. After the expiration date has been met, you can no longer apply a coupon discount on your favorite pizza. Now, imagine there was a market out there to sell and buy those pizza coupons. Obviously, people would only want to buy those coupons if they haven't expired yet, but people who naturally value these coupons much more if the expiration date is further away from the expiration versus say a pizza coupon that's about to expire in one day. Now, there's a time value with these coupons if the pizza coupon market existed. So let's get back to the stock market and options. Most stocks or underlyings have these coupons, but these coupon prices fluctuate every second during stock market hours. What influences these option prices includes the stock price itself, time left until the contract expires, and uncertainty or fear about a company. We'll tie these three critical components of an option price later in a follow-up video related to the Greeks, and trust me, learning the Greeks is not that hard when you simplify it to the core. So smash that like button and subscribe, because we're about to sell a buttload of pizza coupons, options. selling options instead of buying it. Unlike a pizza coupon, with calls and puts, you can lock down a specific price of a stock, whether it goes up or down. We talked about how we want the price of a stock to go down when buying puts. But what if we want to sell puts? What direction would we want the price of a stock to go? If we sell puts, we want the price of the stock to go up. It is in reverse versus buying a put, where we want the stock price to go down. Now, why would we want to sell options, specifically puts? Because most option contracts expire worthless when the expiration date of that contract has passed, which sucks big time for the buyer, but is awesome for you as a seller. When you sell an option, you are rewarded with what's known as a premium upfront from the buyer of that option, which means that you get cash right away into your brokerage account as soon as you complete a sell transaction of an option. Because there's an expiration date to options, each day that passes by means that an option loses time value, or theta, which we'll discuss further in detail in a follow-up video covering more advanced option concepts and strategies. So back to the previous question, why sell puts? Because even if you sold a put and the price of the stock of a company goes down, you're selling puts on a specific stock you want to own anyways. It's like getting a discount for something that you wanted to buy. So let's go through the first scenario, an example of selling Microsoft puts and waiting until expiration. Let's say that you sell one put of Microsoft at the strike price of $200 that expires in 45 days. Let's say one share of Microsoft is currently valued at $210 to make things easy. If you decide to sell one put with a strike price of $200, this means that if Microsoft drops to $200 or below, you'll likely get a sign, aka you'll need to buy 100 shares of Microsoft at $200. Now here's the kicker, because you sold one put of Microsoft, that contract has a value because it still has 45 days left to expire, and therefore you're rewarded with what's known as the premium for selling that put. Like I mentioned earlier, most contracts expire worthless, which is great for you as a seller and bad for the buyer. Let's say the premium you got for selling one put of Microsoft at $200 strike is worth $550, which is realistic for a $10 stock price difference of Microsoft. Now let's say 45 days passes and Microsoft is now worth $200.01. Because the price of Microsoft is 1 cent higher than the strike price of the put you sold at $200, you get to keep the entire $550 premium because the price of the put contract is out of the money. Of course, you'll owe taxes on this premium, which by the way, you could do this in your Roth IRA and avoid taxes altogether. Anytime an option is out of the money and has reached the expiration date, it will expire worthless. In this example, for the contract to be in the money, the price of Microsoft would need to be $200 or less. After expiration, you can then simply sell another put and gain another $550 premium. Not bad for pushing some buttons on your cell phone. Now let's go through the sports betting analogy. Unlike sports betting, where you have to wait until the very end of the game for an outcome to happen, you can exit a position profitably without having to wait until the very end of the contract to expire in options. Now let's say we made a bet on the Golden State Warriors winning against the LA Lakers. It's the final quarter with 10 seconds left on the clock. The score is literally 102 Warriors versus 100 Lakers. Anything can happen. Because we had to wait until the very end of the game to win our sports bet, we can easily lose our entire bet because the sports betting situation is binary. Unlike sports betting, options is not a binary event. We can exit our position anytime for a profit, especially if the conditions are favoring our original bet. We don't need to wait until the very end when the put contract we sold expires to make a profit. Let's go through an example of this back with Microsoft. So scenario 2, closing the contract early for profits. Let's go into a second scenario with selling puts, where you sold a put of Microsoft at $200 strike with 40 to 5 days left to expiration. Again, for the ease of this example, let's say Microsoft is worth $210 today. In the second scenario, let's say that Microsoft actually goes up in price to a nice $220 per share within a week of you selling the original put contract. Now remember, when we sell puts, we want the price of the stock to go up. Selling puts is a bullish move. When we buy puts, we want the price of the stock to go down. Since Microsoft stock has gone up in value in a short brief amount of time, you can actually profit within a week or less versus say waiting until expiration. I've been able to close positions for 60% max profits within 1 day because the movement of the stock price went up drastically. In this case, since the price of the stock has gone up, the value of the put contract we sold has gone down in value. Since we sold one put contract of Microsoft, this means that we're currently at -1 put contract of Microsoft, and we can make amends by buying one put contract of Microsoft to be at 0 put contracts with the exception of now being up in profit. We can easily get around 50% max profits of the original $550 premium we obtained by closing out the Microsoft put contract early, in which we sold by buying the contract for a cheaper price. This is like virtual arbitrage. We sell high and we buy low to close our position, versus in the case of stocks where we buy low and sell high to close our position. Now let's do the math on this. We sold one put contract, which puts us at -1 put contract, but we gained $550 at the start. Microsoft stock within a week goes from $210 to $220, and now that same put contract we sold is now worth $225. We buy that same put contract a week later at $225. We now have gone from -1 contract to 0 contract to be net even, and we are left with $550 minus $225 for a net profit of $225. Scenario 3. What if I'm assigned 100 shares of selling one put? Don't be afraid. Now let's go with another scenario and say that 45 days passes by, and instead of Microsoft being valued above $200, which is the strike price of the put we sold at, Microsoft is now worth $197.50. Even if this were the case, our trade is still profitable. Remember, we sold our put contract to Microsoft at a $200 strike price for a premium reward of $550, meaning that Microsoft can go as low as $194.50 for us to break even, which is known as our cost basis. How much it costed us for one share after the premium received. Since the expiration date has occurred and Microsoft is now worth $197.50, the put contract is now in the money, meaning the person who bought the put contract now has a right to sell you, aka the seller of the put contract, 100 shares of Microsoft at $200. They may or may not do this, as they had the right but not the obligation to carry through with it. But you as the seller of the put contract have an obligation to buy 100 shares of Microsoft at $200 if the buyer decides to exercise his right. Now remember, the put contract would be out of the money if Microsoft stock is valued over $200. Imagine if this hand was $200. Anything above this hand is worth more than $200, and now we're talking about puts that would be out of the money, meaning they would expire worthless at the day of expiration. And then anything below this hand would be worth less than $200 and therefore would be in the money, meaning they would have value at the day of expiration and can be exercised by the buyer of the put. So let's go to the continuation of scenario 3, capital requirements of selling puts and break even. So let's say you meet your obligation to buy 100 shares of Microsoft at $200. Now remember, one option contract is equal to 100 shares of the company. This trade would require us a capital of $20,000 minus the premium you received. So this trade requires at least $19,450 to make it happen, with you selling the initial put of Microsoft at the $200 strike price. This seems rather excessive in terms of capital requirement, but think about the return. $550 of 20K is a 2.75% return in 45 days, with odds that are in your favor. Also know this, if we can perform this action of selling puts on any stock. So if you don't have the dough to sell a put on Microsoft, we can sell puts on cheaper stocks with capital requirements as little as $1,000 or less. Now remember, we want to be the casino selling to the gambler. We'll discuss odds in another video, so make sure you smash that like button and subscribe. It's possible to get a return much sooner, especially if Microsoft stays at the same price or goes up in price. Again, let's say you get assigned 100 shares of Microsoft at $200. Because you received a premium of $550 for selling that one put contract, your break even is one share of Microsoft being $194.50. Now let's do the math on this. 100 shares of Microsoft at $200 is $20,000, which is our initial investment if you got assigned through Microsoft becoming $200 or less in price. $20,000 minus $550, which is the premium received, is $19,450. $19,450 divided by 100 shares is $194.50 per share. So that explains to us why the break even for one share of Microsoft is at $194.50 if we received a $550 premium for selling one put contract of Microsoft. If we sold one put of Microsoft at $200 strike price, and the price of one Microsoft stock at expiration of that put option is now $197.50, this put option trade is still profitable by $300. Now let's do the math on this. We got assigned 100 shares of Microsoft at $200, which is 20K. $20,000 minus $550, which is our premium, is $19,450. Let's say that Microsoft is currently worth $197.50 a share. Our 100 shares of Microsoft that we got assigned is worth 100 times $197.50, which is $19,750. $19,750 minus our break even, which is $19,450, is $300 net profit after the expiration of the put contract. At the time of expiration, we can sell our 100 shares that we got assigned of Microsoft immediately for a net profit of $300. Or we can do what's known as the wheel strategy, which involves selling a covered call, which we'll discuss next. So let's go to another continuation of scenario 3, the will and covered calls explained. Even if I got assigned 100 shares of Microsoft, because Microsoft dropped in value, it is far better to buy 100 shares of Microsoft at an average price of $194.50 versus buying 100 shares of Microsoft at $210 had you never sold a put. Don't you agree? We saved $1,550 by selling one put of Microsoft at $200 strike, in which we received a $550 premium. Therefore, we received the cost basis of $194.50 per share versus buying the shares directly at $210 a share. We've been talking a lot about puts lately, specifically selling puts. And since we recently got assigned in this example 100 shares of Microsoft, we can sell the shares now for a smaller profit of $300 mentioned earlier. Or we can do what's known as a covered call to perform a strategy known as the wheel. The wheel involves primarily selling puts to start off with on a high quality stock you want to own. And if you get assigned 100 shares, then you can start selling covered calls, which give away those 100 shares. You're ultimately left with sweet premiums once you give away those shares, which I'll explain how the logistics work. Selling a covered call is a bullish move because ultimately we want the price of the stock to go up since we have 100 shares of Microsoft. Selling one call requires you to hold 100 shares of a specific stock, so this is a perfect strategy to reduce your cost basis. Now remember, cost basis is just another fancy way to say how much you ultimately paid for your shares. Recall that after being assigned 100 shares of Microsoft, we paid 100 shares of Microsoft at $200 a share minus the premium received, which is $550, for an average cost basis of one share of Microsoft being $194.50. So let's say that we can sell one covered call contract of Microsoft at a strike price of $205 for $550 premium with an expiration 45 days out. If Microsoft is below $205 within 45 days, you keep the entire premium of $550 because the call you sold expired worthless. Of course, you can close this covered call position anytime you want for a profit if Microsoft stays the same price or if the stock price goes down in value. Since we got a premium of $550, we further reduced our cost basis of Microsoft from when we sold our put to $189 a share after we sold the covered call. Microsoft stock would have to drop below $189 for you to actually feel any pain in terms of losses. If Microsoft is above $205 within 45 days, you would have to forfeit your 100 shares at $205. Even this is a favorable outcome because your original cost basis of one share is $194.50, plus you got paid $550 to sell one call contract. This trade would profit you the following if Microsoft is above $205. $194.50 times 100 shares is $19,450, which is our cost basis. $205 times 100 shares is $20,500. That's how much you're selling your 100 shares for. $20,500 minus $19,450 is $1,050 in net profit from our capital gains due to share price increase. And don't forget the premium you received for selling a call. $1,050 plus the $550 premium is $1,600 net profit if Microsoft is above $205 at the time of expiration of the time you sold your call. In addition, since you held 100 shares of Microsoft, there's a possibility you would get paid a dividend too. Microsoft pays a small dividend around 1%, but it's something, and remember, Microsoft has been growing their dividend like a weed every year and may very well be paying a generous 3 to 4% dividend in the future. Imagine selling a put on a company that offers a much more generous dividend yield of 4% or more. You'll be collecting options premium from both sold calls and sold puts in addition to obtaining a dividend income, thus making the will strategy a triple income strategy. Now, the most ideal scenario is to have Microsoft at $204.99 because this means that you not only get to keep your 100 shares that you bought for cheap, but also the entire $550 premium. Really, the only way to have a covered call suck is if Microsoft continued to drop in value to say below $189 a share, or if Microsoft gained a lot of value to say $250 a share. Why would it be bad if Microsoft went to $250 a share? Technically, it wouldn't be bad because you would still made $1,600, but you forfeited your shares at $205 a share instead of say selling Microsoft at $250 a share. You leave a lot of profit on the table for extremely volatile stocks. But fear not, Microsoft stock is not extremely volatile. In fact, this will strategy works best on fundamentally stable, non-volatile, undervalued companies that are A+ in terms of quality, which we discussed in our last video. Now, what do I mean by volatility? Volatility is essentially any stock that has wild up and down swings, and essentially stable companies trend up slowly over time. Microsoft is a great example of this. A+ fundamentally well-sound companies will trend up over time, and Microsoft fits the bill. And remember, most options sold, whether they are puts or calls, expire worthless, which is fantastic to you as a seller. So in conclusion, selling options can be complicated until you actually do this. I recommend that you either paper trade on a Thinkorswim paper account where you can actually experiment this for yourself, which is what I did until I became comfortable with the idea. Then start doing the will strategy, where you sell puts on undervalued quality companies that you wouldn't mind owning. Remember, we want time working for us, so we want to own exceptional companies we wouldn't mind holding for the long term. Selling puts allows us to own 100 shares of a company for cheaper, as I illustrated in my Microsoft example. But if we get assigned 100 shares, we can ultimately sell covered calls for additional profit. Now imagine we did this on multiple companies to diversify your risk. While far more capital intensive than, say, straight up buying dividend stocks, it's still a strategy worth looking into as you build your cash empire. So remember to smash that like button and subscribe, and I'll see you at the next video.